Well, I think the jobs report tomorrow will be quite strong. The ADP number that came out earlier this week was around 450,000, which was close to the expected number, actually a little bit better than expected. And tomorrow, market consensus is looking for about 500,000 jobs. And the 3-month moving average for job gains has been above 500,000, which is pretty consistent with ongoing economic expansion. Not too surprising, given that we're still about 2 million jobs below pre-pandemic levels. Most importantly to me, though, will be the labor force participation rate. I still think we need to see a pretty big improvement in sort of the supply side coming back, which would also help the Fed in terms of trying to get inflation down.
Absolutely. And I mean, as you've said, recessions don't necessarily indicate a bear market, at least not for long.
Yeah, that's right. So it's interesting. If you look at the history of bear markets and the history of recessions, the really big bear markets do coincide with recessions, but not all recessions have bear markets. And it's about 1/3 that don't, 5 out of 15, 5 out of the last 15. And one of those was the 1990 recession, which was in part induced by the oil price spike from the Iraqi invasion of Kuwait. Not a bad analog to what we're seeing today. And as you noted earlier, oil prices are coming down back below $100 a barrel on WTI. And so that's pretty helpful in sort of backing off of that warning level for the negative supply shock that we've seen in the past that can create recession. So a little bit of a mixed picture and really bears watching going forward, but certainly seeing these oil prices come down is reducing the risk of recession, I would say, slightly.
We've still got a huge worry, frankly, in this part of the world about spare capacity, where they're going to get it, what could potentially happen next with regards to Russian supplies, because people, frankly, it's a toxic asset. People are just not buying it as they were prior to the invasion of Ukraine. When you think about what happens next in the real economy, obviously seeing those oil prices coming down, WTI crude's currently sitting below $100 a barrel, has to be good news for Team Biden. But for the real economy, we're still pretty in trouble, no?
Yeah, it's this exogenous shock that's come along that was the Russian invasion. And now we're, 4 or 5 weeks into it. We're just going to start to get data that will reflect March and will show some of the impacts of that. So that's one of the challenges of tracking economic data, is that it's monthly, comes out with a lag. So we will start to see that and we'll see how it progresses. But so far, I think coming into it, the economy is in a pretty strong place. The inversion that you mentioned earlier on 2s, 10s, usually that's a pretty long leading indicator, and the market is generally pretty positive for the subsequent 12 months upon initial inversion. I think the real concern there with the yield curve is to see it uninvert and start to steepen. And so that's something to really watch out for. The other thing that a number of people are looking at is the 10-year versus the 3-month. And there we still see a very steep yield curve because the Fed is priced to hike, quite a bit throughout the rest of this year.